Everyone grows up hearing the same line repeated over and over again. Renting is throwing money away. Buying a home is the smart move. It's stability. It's adulthood. It's how wealth is built. That idea gets reinforced everywhere. Family conversations, social media, friends celebrating their first home purchase like it's a life milestone that separates progress from falling behind. But here's where things start to get uncomfortable. When the numbers are actually broken down using today's market, that story starts to fall apart. Not a little, completely. Because right now, in 2026, renting is not just slightly cheaper, it's dramatically cheaper. In many markets, the gap isn't a few $100s, it's thousands every single month. And once hidden costs are included, the difference becomes impossible to ignore. The average mortgage payment in the United States is sitting around $2,768 per month. That already sounds high compared to the average rent, which is about $2,000 per month. That's a gap of $768 every month, or just over $9,000 per year. At first glance, that might not seem catastrophic. Many people can justify that difference by saying it's the price of building equity, but that's only the surface layer, because the mortgage payment is not the full cost of owning a home. Not even close. Once the hidden costs are added in, the numbers change dramatically. Maintenance, property taxes, insurance, repairs, unexpected breakdowns. These aren't occasional inconveniences. They're guaranteed expenses that come with ownership. On average, those hidden costs add up to about $15,979 per year. That's roughly $1,325 every single month on top of the mortgage. Now the math looks very different. That $2,768 mortgage isn't really $2,768. It's over $4,000 per month when everything is included. And suddenly the renter paying $2,000 per month isn't just saving a little. They're saving about $2,000 every single month. That's $24,000 per year. Pause on that number for a second. $24,000 every year isn't a small gap. It's the difference between surviving and building wealth. It's the difference between being financially stretched and having flexibility. And this isn't an extreme example pulled from the most expensive cities. Across the 50 largest metro areas in the United States, renting is cheaper than buying in every single one. Not most, all. In cities like San Francisco, the difference becomes almost absurd. Monthly ownership costs can exceed rent by over $5,000. In San Jose, the gap pushes past $57,000 annually. Even in more balanced markets like Chicago, the advantage for buying is minimal, sometimes less than $500 per month. So if the numbers are this clear, why does the belief that buying is always better still dominate? Because the decision to buy a home has never been purely financial. It's emotional. Long before anyone looks at a spreadsheet, the idea of homeownership gets tied to identity. Renting feels temporary. Buying feels like progress. Renting feels like waiting. Buying feels like arriving. That pressure builds slowly over time. It shows up in subtle ways. Conversations that make renting sound like a phase that needs to end. Questions about when the real step will happen. Comparisons with peers who already bought. Over time, that messaging stops feeling like advice and starts feeling like a rule. And once something feels like a rule, it stops being questioned. That's where the real problem begins. Because when decisions are driven by pressure instead of numbers, the outcome usually looks the same. People don't ask what they can comfortably afford. They ask how much they can stretch to qualify. And that shift changes everything. Monthly payments start creeping toward the edge of what income can support. Savings shrink. Emergency buffers disappear. Flexibility gets traded for a fixed obligation that doesn't adjust when life changes. On paper, it looks like progress. In reality, it often feels like pressure. This is how people become house poor without realizing it. The home looks like an asset, but the day-to-day experience feels like a financial constraint, and that leads directly into one of the biggest misconceptions about homeownership. The idea that buying automatically means building wealth. Because technically, yes, equity is being built, but the way that equity builds is rarely explained. In the early years of a mortgage, around 70 to 80% of each payment goes toward interest, not equity. So that $2,768 monthly payment doesn't translate into $2,768 of wealth being created. In reality, only a small portion of that reduces the loan balance. The rest is gone. Interest, taxes, insurance, maintenance, money that functions almost exactly like rent. And that's the part that rarely gets talked about, because once those unrecoverable costs are separated out, the comparison between renting and owning starts to look very different. Rent isn't the only money that disappears. Ownership comes with its own version of rent. It's just distributed across multiple places. The bank takes interest. The government takes property taxes. Insurance companies take premiums. Contractors take maintenance and repair costs. And all of those payments continue indefinitely. From a cash flow perspective, a large portion of homeownership behaves exactly like renting. It's money spent for housing, not money invested. And once that idea clicks, the next question becomes unavoidable. If both options involve spending money that doesn't come back, where does the real financial difference come from? The real difference comes down to what happens to the money that isn't spent. That $2,000 monthly gap doesn't just vanish, it creates an opportunity. When that money is consistently invested instead of absorbed into housing costs, the outcome changes dramatically over time. At around 8% annual returns, that monthly investment can grow to more than $365,000 in just 10 years, and it continues compounding from there. Then there's the down payment. On a $500,000 home, a typical 20% down payment is $100,000. It feels like progress, but once it's locked into the house, it becomes illiquid and non-productive. It can't be easily accessed or redirected. That's often called dead equity. If that same $100,000 were invested at roughly 10% annually, it could grow to about $1.4 million over 30 years, far outpacing typical home appreciation of 3 to 4%. At the same time, ownership comes with ongoing costs like interest, taxes, insurance, and maintenance that quietly absorb cash. Renting, on the other hand, preserves flexibility. It allows movement, adaptation, and access to opportunities, while ownership introduces friction through high transaction costs. Ultimately, the decision isn't just about housing, it's about how money flows and grows over time. Historically, a ratio below 15 suggests buying might make sense. Between 15 and 20 is a gray area. Above 20, renting tends to be the better financial move. And in many major cities today, that ratio isn't sitting at 20. It's pushing into the mid-20s and even 30s. At those levels, the cost of ownership is significantly higher than the value of the housing service being received, which means the premium being paid to own is no longer small, it's substantial. And that's why, in today's market, renting wins far more often than most people expect. Not because renting is inherently better, but because the numbers, right now, favor it. Once the numbers, costs, and trade-offs are fully laid out, the conversation shifts from what sounds right to what actually works over time. This is where the long-term comparison becomes impossible to ignore, because over a 30-year horizon, small monthly differences don't stay small. They compound, expand, and eventually create entirely different financial outcomes. Take that $2,000 monthly gap between renting and owning. On the surface, it might feel like extra breathing room, but when that same amount is treated with discipline and consistency, it becomes something much more powerful. Invested month after month into a diversified portfolio earning around 8 to 10% annually, that difference doesn't just grow steadily, it accelerates. Over 10 years, it can cross $365,000. Over 20 years, it moves into a range most people associate with retirement accounts. And by the 30-year mark, the total can reach levels that fundamentally change financial independence. At the same time, the homeowner's wealth story unfolds very differently. Equity builds, but it builds slowly, especially in the early years where most of the payment is directed toward interest rather than principal. Home values do appreciate, but historically, that appreciation averages around 3 to 4% annually, which is only slightly above inflation. That means a large portion of the perceived gain isn't coming from explosive growth, but from leverage and long holding periods. When comparing these two paths side by side, the renter who consistently invests the difference often ends up with more total wealth and, importantly, wealth that is liquid, accessible, and adaptable. Liquidity becomes one of the most underrated advantages in this entire conversation. Money tied up in a home cannot easily respond to opportunity. It cannot be quickly redirected into investments, used to start a business, or deployed during a market downturn without taking on additional debt or selling the property entirely. That creates a situation where a large portion of net worth exists on paper but remains difficult to use in practice. Meanwhile, invested assets can be adjusted, rebalanced, or accessed with far less friction. This difference might not feel urgent during stable periods, but it becomes critical when life introduces unexpected changes. And that brings up another layer that often gets overlooked: risk. Not the obvious kind, but the quiet, structural risks that come from concentrating so much capital into a single asset in a single location. A primary residence doesn't generate income, doesn't diversify exposure, and doesn't easily allow partial adjustments. It is a large, fixed position that depends heavily on local market conditions. If that market slows, if insurance costs spike, or if external factors begin to affect property values, the impact is concentrated and difficult to mitigate. Compare that to a diversified investment approach, where exposure is spread across industries, regions, and asset classes. The difference isn't just about potential returns, it's about resilience. One system concentrates risk while the other distributes it. At this point, it becomes clear that the decision between renting and buying is not a simple upgrade from one to the other. It's a trade-off between two completely different financial structures. One prioritizes ownership and stability at the cost of flexibility and liquidity. The other prioritizes adaptability and compounding at the cost of long-term commitment to a single asset. That said, buying is not inherently a bad decision. There are specific conditions where it makes sense and can even be the better option. The key is understanding when those conditions are actually met, rather than assuming they always are. Time horizon plays a major role. Buying begins to make more sense when the property will be held for at least 7 years or longer. This allows enough time to recover transaction costs, which can consume a significant portion of the property value when buying and selling. Without that time buffer, even small market fluctuations can turn ownership into a financial setback rather than a gain. The size of the down payment also matters. A 20% down payment not only avoids additional costs like private mortgage insurance, but also reduces monthly obligations and improves loan terms. However, this only works if it doesn't completely drain savings. Entering homeownership without a financial cushion introduces a different kind of risk, where a single unexpected expense can lead to debt rather than stability. Market conditions are another critical factor. In areas where the price-to-rent ratio is low, meaning the cost of buying is relatively close to the cost of renting, ownership becomes more reasonable. These markets tend to offer a better balance between cost and value. But in cities where that ratio climbs into the mid-20s or higher, the premium paid to own becomes much harder to justify financially. Income stability also plays a role. When total housing costs remain below roughly 28% of gross income, the financial pressure stays manageable. Beyond that point, the margin for error begins to shrink, and the likelihood of becoming house poor increases significantly. And then there's the personal factor that rarely gets addressed directly: discipline. Renting only outperforms buying when the difference is actually invested. Without that step, the advantage disappears. Extra cash flow can easily be absorbed into lifestyle upgrades, larger expenses, or short-term consumption. The strategy only works when that gap is treated with the same consistency as a mortgage payment: automated, non-negotiable, and aligned with long-term goals. This is where the conversation becomes honest. For some, the structure of homeownership acts as forced savings. It creates a system where money is consistently directed toward an asset, even if the efficiency of that system isn't optimal. For others, the flexibility of renting combined with disciplined investing creates a more powerful outcome. Neither path is universally correct, but one often gets promoted without acknowledging the conditions required for it to succeed. And that's the part that changes everything. The belief that buying is always the better financial decision isn't just outdated. It ignores how dramatically the housing market has shifted. Higher home prices, elevated interest rates, rising insurance costs, and increasing maintenance expenses have reshaped the equation. What worked 20 years ago under completely different conditions does not automatically apply today. When all of these pieces are brought together, the conclusion becomes much clearer. Renting is not throwing money away when the savings are invested. Buying is not automatically building wealth when the costs are high and the timeline is short. The outcome depends on how each option is structured, how consistently the strategy is followed, and how well it aligns with real financial behavior. The real advantage doesn't come from choosing one label over the other. It comes from understanding how money flows within each system and making a decision based on that reality rather than inherited assumptions. Because at the end of the day, the most expensive mistake isn't renting for too long. It's buying into a system that quietly drains resources without delivering the outcome that was expected. The difference between those two paths isn't just financial, it's freedom, flexibility, and the ability to make decisions without being locked into a structure that no longer fits. And that's what this entire conversation comes down to. Clarity. Not pressure, not tradition, not what everyone else is doing. Just clear numbers, honest trade-offs, and a decision that actually works. If this breakdown changed how renting versus buying is viewed, hit like so, more people see the numbers before making the biggest financial decision of their life. Subscribe for more breakdowns that cut through assumptions and focus on what actually works. And drop a comment with which side makes more sense right now, renting or buying, and why.